where do you start as an investor if you wanted to have cash that's working, but it's not necessarily exposed to too much risk?
It's a tricky one, isn't it? Because when you see a set of economic conditions which you could describe as recessionary, it's a red flag for people, and it's usually panic mode and let's revert to safety, which for most people would be holding cash. Yeah, as you rightly say, there are multiple areas of the investment landscape that typically perform quite well. I'll give you a very candid example of that, and that is debt collection businesses. From a direct stock investment, and there's a brilliant business up in Brisbane, doesn't exist, it's been acquired now, called Collection House, which was in the bad debt recovery space, which during a recession is absolutely halcyon times for that kind of business. So there you've got a stock whose share price is going through the roof during a time where most stocks are getting panned. So within the sort of morass of difficulty, there are opportunities for picking up quality businesses. So that's an example of a very, very niche business which does very, very well under those sorts of circumstances. But more broadly speaking, asset classes which you would expect people to look to, growth type opportunities are the first things that kind of get cut. Discretionary spending businesses that typically get cut during tougher times. But things like consumer staples, groceries, for example, ultimately, whether the Nasdaq's up or down 50 points overnight or 500 points overnight, you still need to buy your food. And so stocks that are in that grocery space are typically much more defensive. Equally, from a stocks perspective, pharmaceutical companies,
healthcare was on my mind too.
Exactly. So, we've just seen a weaker quarter of GDP. I think I'll forego my prescription medicine this week is not a conversation that people would typically have. So again, they can be more defensive areas. Utilities also, you still want the electric or gas on, whether the economy is booming or not. So those sorts of areas are safer places to play within the direct equity markets versus the growth businesses or consumer spending or discretionary spending type businesses that tend to suffer when people don't spend. Other asset classes, as you say, things like bonds where there's a fixed income component to that which keeps your income flow happening and may offer an asset that's a little bit more stable through those more difficult times. The challenge is that bonds typically don't perform when you're at times of inflation, and during a recession is not normally inflationary, so they tend to do a little bit better. So as an asset class, certainly can be a little bit better. Gold potentially as a flight to safety, although that doesn't pay a yield, can be a little bit of one of those assets that the sort of life raft that people jump towards, and they will be certainly examples. And within the bond market, you can get things that are inflation protected assets. You can get capital protected assets too, which I guess we may move on to as a subset too.